Hello and welcome to Project Trade. This is the Technical Indicators Show. And we've got a great one to talk about today. It is the average true range, initialized as the ATR. Certainly one of the most used indicators in all of technical trading, and not without good reason as to why. It's brought to us by Wells Wilder in his 1978 book, New Concepts in Technical Trading Systems, which is one of the more prominent books to arise in the history of technical analysis. The ATR is a useful volatility indicator which appears as a single line oscillator. But it's not useful for telling you the price or which direction a trend may be moving, where the momentum is at. No, it's mostly useful because of how it can be used as a money management tool. And we will get deep into that, but for now, let's take a look at the engine powering it so we know exactly what we're working with. And before we calculate the ATR formula, we first need to calculate an integral part of that formula, which is the true range. And that is the left side of our equation there. The formula may look complicated if you've never seen it before, but allow me to explain. The true range is the largest of the following three calculations: the high minus the low of the current period, which gives us today's complete range, the high of the current period minus the close of the previous period, or the low of the current period minus the close of the previous period. From these three options, it will choose the biggest of the three, that is the max part. And something important to understand here is the term of absolute, or abs, in the equation. What this means is that there are no negative results allowed from the calculation. Any negative numbers are flipped to be positive. For example, if a stock price has a current period low of $10, which subtracts from a previous lows of $11, 10 minus 11, that would normally give you the answer of -1. But because the formula incorporates the term absolute, the answer would be +1. If the term absolute wasn't used, then the low less previous close calculation could never be more than the high less previous close calculation. So it is an important part to know and understand about it. In case you're still unsure, here are three scenarios demonstrating how any of these three choices could be the largest depending on the price action. Between the range of $12 and $10, we can see how often the ATR would simply be the high minus the low from today, like on the left. But the latter two scenarios do show how a gap up or a gap down on an asset can cause the high or low of the previous period to be the largest of the three options. Okay, now we understand the true range formula, we can move on to the full average true range formula. And that is calculated by taking the previous period's ATR reading, multiplying it by the number of periods input into your ATR less 1, and then by adding on the current true range. You take that figure and divide it by the number of periods, and there you have your ATR value. There is one more part to the average true range, and that is the very first period of the indicator. I won't go into detail on it, but I will leave the formula on screen for a moment for anyone who is hand drawing their oscillators and needs that first period information to get things rolling. Hopefully the base formulas at least make sense. It does get a little complicated, but at least now we know how it works at its core, which means that you yourself could explain it onto the next interested person and save them some clicks. And what do all these formulas come out looking like? There it is, that single line oscillator, which as you can see here is using the default setting of 14 periods. On the right hand side it does keep its scale, which is not a fixed scale like some oscillators may have a bounded range of 0 to 100 for example, but not with the ATR. In this the readings are particular to whichever chart you happen to be on at whatever given time, as it is reading the range for the particular asset. That market specific reading it gives is a key part of the utility of the ATR. If you are trading two separate forex currency pairs, for example the euro dollar and the pound Swissy, yes they are both currency pairs, but that doesn't mean that their volatility will be equal. If the euro dollar pair was say 3 times as volatile as the pound Swissy, according to the ATR at least, then it's difficult to justify putting the same amount of volume risk on one pair as you do for the other. The ATR will try and help keep you grounded by making sure that you don't unwittingly over leverage due to being unaware of an asset's volatility. In the top left hand corner where it reads 0.9, that would be our current ATR value, which is often relevant at the point of entering your trade if you're using that figure as say 1 times ATR or 3 times ATR. That is the figure that most people pay attention to. And there is only one input into the ATR, and that is the number of periods you would like, which will inevitably have some impact on the reading you receive. The default setting and what Wells Wilder built the indicator around was the 14 period input, and often traders do stick to this number. But what happens when you do go for something that's either shorter or longer? In this particular example of a short 5 period ATR and an extremely long 150 period ATR, you can see the 5 period reacts very quickly, taking a bumpy ride on its path, whereas the 150 naturally has a much more smoothed out journey. This is what you'd expect, and although these readings of 1.506 and 1.759 haven't currently drifted too far, Sometimes they can vary by quite a bit. Here, the ATR 150 period reading of 5 pips is over twice that of the 5 period ATR, which is at 2 pips and 1 pipette. This changes your risk factor by quite a lot, despite the fact that the price is equal for both the readings. Also, the low of the 5 period scale goes all the way down to 0.0002, whereas for the 150 it's 0.00039. That's 19.5 times the 5 period reading, which indicates a big difference in where they could top or bottom out. Remember though, it's not inherently bad that the 5 period is quick to respond or that the 150 is slow to respond. You may be using a strategy that revolves around a particular time period or average range. I personally do prefer to use the default 14 periods for most ATR strategies as Wilder intended, but do play around with it yourself and see what works, because you never know what you might find. There could be a strategy for world domination hidden within the ATR. But just in case there's not though, let's see what entry signals we can get from this one. Firstly, as we said, if you're watching only the ATR, well, you might see that volatility is increasing, which may clue you to thinking that a trend is forming, which would make sense. However, you cannot confirm with the ATR alone that it is not just a volatile range that will only be settled after bulls and bears battle it out. Essentially, there is no way with the ATR to tell if this increased volatility is moving to the upside, the downside, or neither. Obviously, I can point out that if you are using the ATR, you would of course have the actual price chart in front of you to see, but then you're suddenly eyeballing the price action and you're running on feelings, so good luck with that. You know, Ivan Boesky was someone that had great feelings when it came for price charts. Those feelings would later be referred to by the court as insider trading. Let's not get sidetracked though. The point is that if it is a trend you're wanting to jump on, you're going to need other indicators at work too. Or you could just use it as a filter on volatility for whether you trade or not. So if a high ATR for whatever asset you were trading was say 35, well you could say that you would only trade with a volatility above 35. It's a way to tell you that there's quite a lot of action going on in that particular market. But again though, the ATR is not going to do the heavy lifting for when you're entering the trades. So if the ATR isn't about the entry signal, let's go to the main reason that this indicator finds its way into so many traders' strategies. You know it already because we said it at the start of the video, and probably you just know it anyway. It's money management. And so let's start with the stop loss. The ATR is pretty much the go-to technical indicator when a trader is looking for a technical measuring tool to aid them in setting up their stop loss. It really does have a good handle on market-specific price volatility, and that information gets funneled through to our stop loss decision, one of the most important decisions that you make in trading. If you are trying to make money consistently from trading, then a stop loss is going to be critical in every trade. And so if you're setting a stop loss on every single trade, then you can understand how it makes sense that the ATR ends up being used in so many strategies. The distance you set your ATR from the entry price though will still differ depending on the strategy. Some of the more common stop losses that traders use are 1 times the ATR from stop loss, 1.5, 2 times. It does tend to stay at these lower numbers where you're giving your trade room to move, but you're not willing to let the trade go against you for too long. If you do want to increase this number to anything of your choosing, that is on you, but it certainly is an option. For example, if you're trading on lower time frames, you might want to stretch it out to 4 or 5 times the ATR just to avoid some of that noise. Let me be a little bit clearer and just explain again how all this works. So here we are enjoying our day, having a look through charts, and we take a look at the Bitcoin hourly chart, and wait a second. Well, that price is tipping off a little, and if we draw a bit of a crude trend line here, oh my goodness, that price is falling off of a cliff. I'm an absolute genius. So then we grab up the ATR and we jot down that reading of 439.47. That is the current ATR value. And we dive headfirst into a sell trade with a stop loss of 1 times the ATR value. You can see that white dotted line there, which is above the sell order. That is our stop loss. That was calculated by taking our entry price of 34601.2 and adding the ATR value of 439.47, which gives us our stop loss of 35040.67. Naturally, we can mirror that with our take profit and say that we will take that profit at 1 times the ATR value from entry price. If you look in the bottom left, you can see already that the ATR value has shifted from its original value to 440.75. However, we will keep our original value that we entered in with, and that is 439.47. So with this one, it's calculated by taking our entry price again of 34601.2 and subtracting from it the ATR value of 439.47. That gives us a take profit value of 34161.73. Of course, we can tell from the trend line though that this is not going to be nearly enough profit for us. This time we've adjusted the take profit to 10 times the ATR value. It's that white line all the way down the bottom there. It's beyond our trend line and beyond all rational logic of risk management. But maybe you have a reason to, I don't know you yet. Don't worry if it is still confusing though, I am going to go through one more full example of a common ATR money management system, and this time we'll include a trailing stop loss. The trailing stop loss is a type of stop loss which, as the name suggests, trails behind the price, and it trails at whatever distance you tell it to trail at. And one of the crucial things to understand about a trailing stop loss is that it never falls back from where it is originally set. This would defeat its purpose. Let's say you set a trailing stop loss of 40 pips, and for the first time your trade gets to 60 pips profit. That means that the trailing stop loss would be at the 20 pip profit mark. Even if the price crashed down hard, the trailing stop loss would not budge from that 20 pip profit mark. Got it? Okay, let's bring up that new example. Here we are on the 15-minute chart for gold, and as we're always feeling lucky, we gamble on a coin flip, which comes up at a buy. So immediately in we go at a price of 1757.8 US dollars for a troy ounce, or roughly 31.1 grams. And just a note for your own reference, a regular ounce is 28.3 grams. Let us not digress though, and instead let's look at our ATR value down there, which is 2.01, aka $2.01. We have now the building blocks for our trade, and we are going to split our trade into two half trades. Our first half trade, we're going to set both the take profit and the stop loss 1 times ATR value up and down from the entry price. We are able to just plug in 201 points straight into our trading platform, but you can do this simply enough so long as you either have a calculator or a willing mind, because it's just taking our entry price of 1757.8 and adding 2.01 for our profit and taking off 2.01 for our loss. The second trade will also set a stop loss of 201 points from our entry, so we'll have both trades stop out at 1755.79 if things do go completely wrong for us. But for the take profit on our second half trade, we are going to keep that open for now. Here you can see that 1 times ATR value distance both up and down. That green central line being our entry price and the white lines either side being our take profit and stop loss. And praise be to Madoff, we are in luck. Our take profit has triggered on the bar immediately after we've entered, as there was a really quick run up there. Now that our first half trade is closed successfully, we can take a little look at our second half trade. We're still going to keep that take profit open, but this is where we change that stop loss to be a trailing stop loss. This trailing stop loss is going to be 1 times ATR value back from where the other half trade triggered its profit, aka our entry price. That's right, at worst we go out even on this half trade and end the whole trade with a little bit of profit, or who knows, it could run for hours, days, even weeks maybe. On the next bar the price did drop back into its range and the trailing stop loss triggered at our entry price. So towards the bottom of the screen you can see the core outline of our trades. Highlighted in green we see where the take profit triggered for our one half trade, 1 times the ATR value from our entry price, and in red for the other half trade we can see where that trailing stop loss did trigger back at our entry price. Nevertheless, a winning trade, and it was a real trade taken with completely real demo money. Hopefully that is understood now, because the ATR, it can be used across all markets. Similar to a lot of volatility indicators, especially if you're on a lower time frame, you may find a sudden spike at important times such as the release of economic numbers or when the stock market's open. If you are trading with the ATR just before these times, when the upcoming volatility is yet to be accounted for, you might want to consider increasing your ATR risk multiplier to not get cut out by early swings in the price. But this can apply on the longer term daily and weekly time frames as well. At that macro level, certain markets will come in and out of favour with investors, and therefore volatility can increase for certain periods of time and then seemingly disappear for others. If you're looking for similar indicators to the average true range, there isn't too many that do it quite like the ATR, but there are a couple in the field which I'll touch on. The standard deviation indicator can be used as a swap out for the ATR, as it does give readings based on what it determines as the current price range, which you can then apply as a stop loss or take profit trigger. Here's a comparison of the ATR and the standard deviation indicators, both using 14 periods. You can see that certain elements of their paths are undoubtedly alike as a whole, but along the way certain parts don't quite match up. The current readings on this particular example are not too dissimilar, with the ATR at 21.09 and the standard deviation at 24.67. I mean, the standard deviation, it's worth a go to see if that works better on a particular asset, but the ATR is still the choice for most traders. Moving on, the KELTNER channel is a 3-line volatility and trend indicator that sits on a chart in a similar way to that of the Bollinger Bands, if you're familiar with those. If not, here is the KELTNER channel. As its central line, it uses a moving average, and then the upper and lower bands are set 2 times ATR above and below the average. Here we're just using the default ATR input, which is 20 periods, and you can use those bands for either stop loss or take profit triggers. The next one we're looking at is the chandelier exit, which is also a volatility indicator incorporating the ATR into its inputs, and it can also be effectively used as a trading stop loss. Here it is, and you can change any of these inputs. As a default, it's using a 22 period ATR with a 22 period look back, and we've loaded just one multiplier setting with the default input of 3 times ATR distance. So if we'd been in a buy trade for all of that uptrend from the bottom of the blue line, you can see that our stop loss would have trailed that blue line all the way up to where it is now based on that current price. And the reason you're seeing indicators like the KELTNER and the CHANDELIER, it isn't that they're trying to be the ATR, but the fact that people are designing indicators and they want to incorporate the ATR into their own, it's another testament to the usefulness and versatility of the ATR. And that is but a few indicators that are relatable to the ATR. There are many more out there that are trying to be just like it, or at the very least incorporate it. But that mimicry and utilization should certainly be taken as flattery. In conclusion, if you are one of the people that believes in using tiers to rank your indicators, then this is probably a tier 1 indicator. And when you know how to use it, you understand why it's used as much as it is. It can help assess price volatility when you're looking for breakouts, which is not a bad use if you've got good price direction indicators backing you up. But it is earning its stripes as being a very versatile money management tool, which as demonstrated can be used as an indicator for determining your stop loss, your take profit, and your trading stop loss as well. If you're someone who is getting into technical trading, this indicator is a must learn, and so kudos to you for learning about it today. Hopefully it can help your results, and if you want to know more, I will leave links in the description. And lest we forget that every chart and indicator example I've shown you today is completely rigged. I do go out searching for these charts to show you how an indicator may or may not work, so do be very careful. If you do want to see this indicator in live forward testing action though, we have done that, and I will also link those videos in the description. This is Project Trade, and we are the traders of the lost chart. Thank you for watching or listening.